Today's episode of Wine and Dime is sponsored by Rooted Planning Group, a fee-only financial planning firm that believes life is about events, supported by your dollars and cents. And we want to help you achieve your goals. Hop on over to www.rootedpg.com to learn more about the services. Every week, it's my goal to share financial information that helps you in both your life and Financial Vineyard. We hope it takes you from your roots to the journey of your vines and the influences in the air that have helped craft your delicious life. Like wine, life and finances have different palates that should be celebrated and not judged. Hi, Wine and Dime listeners. This is Amy Irvine, CEO and founder of Rooted Planning Group. And today I am fortunate enough to have Kate Welker here joining me again on the podcast. As you may recall, Kate is one of our financial planners, and we are going to be talking about some fun topics I'm sure everybody is thinking about right now. A couple of things, actually. Kate, welcome to the show.
Hi, Amy. Thanks for having me back. It feels like it's been a little while, so I was excited to be on.
Yeah, it has been. Maybe too long, I think. So Kate and I were sort of jamming prior to the session, thinking about some things that clients were asking us. And one of the questions that we've been hearing a lot about is if people should be pulling money out of the stock market right now and putting it into cash because cash is yielding such a high rate of return. Kate, what is your opinion on that?
Well, if you listened to last week's podcast, I think the discussion was a little bit around asset allocation. And when you talk about pulling money out of the stock market, you want to make sure you're still sticking with your goals and objectives. You're not doing it out of fear. But if you have, when we look at your equation, you've got one side that's your stocks and equities, the other side that's fixed incomes. And that could be bonds, it could be CDs, it could be cash, it could be money market funds. And right now with the rate money markets, if you interested in, you could take a piece that has previously been allocated to bonds or more particularly just cash, and it would be ideal, and using a money market fund to get a higher rate of return right now. And we don't know how long that rate will continue. So it's not a guaranteed rate, but for the moment, while rates are up, there is returning a nice about 5%.
Yeah. And your point about it, we don't know how long that is going to continue. The thing that I think a lot of people don't realize, one of the differences between another fixed income vehicle like CDs and money markets is that CDs, when you buy them, they're locked in for whatever the term is. So if you buy a 1-year CD and it's at 5%, it stays at 5% during that 1-year term. Money markets don't work that way.
No, money markets don't, because with the money market, they're trading in very short term, treasuries and investments. So it's going to be based on what the current rates are, what happens with stated interest rates, where we're seeing trading. So it could change daily, weekly, monthly, what we're seeing. So you will need to be a little more on top of it. If maybe that's not for you, or you're afraid you'll forget to follow up on it, that might be why you'd want to look at a CD instead. So you could lock that rate in. We've actually been seeing the long-term rates finally starting to climb up. Last week I saw callable bonds, not your non-callable, that you're guaranteed the term over 5%. And the long-term, I think a 5-year, I saw at 4.6. So we're starting to see a lot higher rates longer term than we were before.
Yeah, the yield curve, as they call it, is starting to level out just a little bit. It's still not there yet, but it's starting to level out. And I know I'm starting to lock some laddered returns in over the long term, because even if the Feds do raise interest rate another time, as they've talked about doing, I still feel like, rates could adjust quickly on the longer term more so. So I'm starting to put things out there. One of the things that I think is probably, I just used a term about the yield curve. Now, a lot of people don't really understand what that yield curve is. So maybe we should take just a few minutes and talk about that. If you think about a flat line, like let's just in your mind put a flat line. Now, don't flat line on us, but if you have a flat line that you're thinking about, if you have a flat line yield curve, then a 3-month CD is going to be 5%, and a 5-year CD could be 5%, and a 10-year CD could be 5%. So that's a flat yield curve. So we've heard a lot about an inverted yield curve. So maybe Kate, explain what that is just a little bit to the listeners.
Well, in inverted, think of opposite or reversed what you would expect, where shorter term interest rates are a lot higher than longer term. So I just mentioned that longer term CD rate. Earlier this year, we were seeing CDs for 3 to 6 months at 5% and a 2 to 5 year at 2%.
Yeah.
So it didn't, you wouldn't want to lock in longer term because it was upside down. When you think almost like common sense would be like, well, doesn't it make more sense to lock in longer term? It didn't at that point. It was reversed or inverted.
Yeah, inverted. And so now, because like you just said, we're starting to see that level out. The normal curve would be that your short-term rate is lower and your long-term rate is higher. And why that would be normal is because if I'm going to let you use my money for 5 years, you have to pay more for that. And it's the same if you think about a loan. Like if you're borrowing a loan, typically the longer the term you borrow the loan for, the higher the interest rate. Or the shorter you borrow the loan for, the lower the interest rate. Well, that's really what's going on with bonds and CDs and even cash to a certain extent, because we're talking about short term. So to answer the question, I think going back to what you said earlier, that we're being asked, should I take some money out of the stock market? We're recording this podcast on October 6th after a relatively volatile,
that's a great word,
volatile month of September. And even the first week of October has not been overly friendly on stock prices. Would you, thinking long term, now these are not short term cash needs. Why are we constantly giving the opposite advice of putting more money in the stock market versus taking it out of the stock market right now?
So if you look historically and at the long term, your long term rate in a stock market based portfolio will historically return more over the long-term horizon than a cash basis will. Because right now, that money market we're talking about is paying 5%, but 4 years ago, they paid 0.04%?
Yeah, if you were lucky.
Very, very low numbers. So if you historically average those rates, you're getting 1.2% over history on a cash basis, like a money market would be. For your portfolio, you could see, all depends on what you're getting, but more like a 7 to 8 to 9% historical rate of return. So for a long-term investment, staying steady in the market is a more successful.
Assuming that happens. And I know some people have had some concerns, like, is the stock market going to perform better than the bond market because of higher interest rates, right? And of course, we can never determine that right now. It's always backward looking. But I can say that, again, if you look historically, we've had other periods of times where bond markets have had high yields like they do right now. And ultimately, the stock market still does outperform the bond market. And again, another term that I really want to define, I was talking about bond yields. Right now, when we're talking about yields, new issue CDs and bonds are coming in a little bit higher, like 4.5% to 5%. So if I'm a bank or I'm a corporation or I'm an organization that wants to borrow money, I'm depending on my risk, how risky I am, I'm probably going to be paying you 5 to 6% on a bond that I'm issuing right now. However, when we talk, that's the coupon, right? When we talk about yields is a whole different animal, right? So yield gets confusing because if you are not a new issue and you have a bond that was issued 5 years ago, well, because interest rates were rising, the prices of those bonds were falling. And so now something that has a coupon of like 2% might actually have a yield of close to 5%, because if I want to sell that 2% bond, I have to give that to you at a discount. Now, if that's not confusing, do you have a better way of maybe explaining that than I do, Kate? Because I think, it's really, people hear terminology like that, like bond yields are at a 20-year high. There's a difference between yields, though, and coupon. And maybe I guess you just need to know that.
Yeah, if no one can see me, I'm sitting here with a deep thought look as a better comparison. And this is something that, even being in this industry for years, I still find, like, the thought, I have to really think through coupon and yield and, yield to maturity. Just really think it through, because they can be topics.
They can be challenging.
I'm going to think of a good analogy and report back at a later podcast.
Well, good. We'll be glad to have you back on in a later podcast to go over this particular topic. And I know we've got a tax season. I hate to say this, but we're into the fourth quarter. This becomes a very busy time for us, running sort of some projections, year-end projections elections coming up, and we want people to start thinking about making some decisions around their taxes at the end of the year. And I've been doing a series about different types of retirement plans that people can actually contribute to. And one that you actually have a little bit more time to dig into is IRAs. But any thoughts around some last minute tips towards the end of the year that people might be able to save a little bit more on taxes around savings vehicles, just in general?
Yeah, absolutely. So as Amy just mentioned, IRAs and Roth IRAs, you have a little bit more time because you actually can contribute to those up to April 15th of the following year, the tax filing deadline. But it's still good right now to take a look at where you're at. So, for example, maybe your 401k or 403b through your employer, you haven't maximized yet, or even if you're not maximizing, you just have a little extra cash funds, cash flow available, so that you could instead say, all right, I have extra money I want to save somewhere. Let's increase my 401k deferral rates. And that's going to lower your taxable income between now and the end of the year. Another strategy that we will be looking at with, particularly with clients right now, and I'm not sure we have time to get the whole topic, but would be Roth conversions. So with a Roth conversion, you can take money that is in a tax deferred account. So like a traditional IRA that you have not paid tax on, you can elect to pay the tax on it and put it in a Roth IRA, which as long as you keep it in there for the withholding requirements, you will not pay tax on that or the growth.
And so people might use that to fill up their tax bracket
exactly.
this year, right?
So if you're looking at where you're at and doing a little projection to see where you're going to be by the end of the year, if you're solidly in a tax bracket and you think it's going to be higher in the future, it might make a lot of sense right now to see how much room do I have left in that tax bracket before I jump up and consider doing a conversion right now.
Yeah. I think that's a great tip. And I think the bottom line that you're trying to get at is, run some numbers right now.
Run some numbers right now. Yes.
Once you get to the end of the year, you don't have a lot of options after December 31st. But right now, we actually have 3 months or 2.5 months by the time this is released to really, make some changes. And do not wait until December 15th because you won't get it done in time.
Even if you think you can get it done, the organizations, the custodians you're working with, they are slammed. No, it's a great time. I know I sent my husband a message the other day. I said, can you please bring me home a pay stub? Because I was doing this myself.
Yeah, we do it on ourselves.
Yeah, this is just a good time of year to check in with where you're at.
Yeah. And I do want to mention, because I didn't at the beginning of the podcast, I was so eager to talk about this topic. Kate and I are going to be we're actually traveling together right now as we're recording this podcast, and we're going to be enjoying a bottle of Lemberger wine tonight from Lakewood. I don't even think Kate knew that. She's looking at the expression on her face. So for those of you that are looking for the wine tip of the day, my wine tip of the day is Lemberger from Lakewood. It's a really luscious red wine, for those of you that are wondering. So very peppery, very smooth. I think it's going to be helpful to Kate to wind the evening out with that after traveling with me for 2 days. We want to say thank you so much for listening to the show today. We hope you have enjoyed this episode. We'd love it if you would share it with your friends and rate us on iTunes so that more people can find us like you did. And a big shout out to TJ Mann at Mann Media. We are so appreciative of all the faux pas and the blending that he does during the production of this podcast. Thank you so much. And Kate, again, thanks for joining us.
Thanks for having me. Bye.
And that will about do it for today's episode of Wine and Dime. You can contact Amy through the website, www.rootedpg.com, or amy@rootedpg.com. You can also follow us on Facebook and Instagram @rootedpg for the latest news. And if you have any questions, comments, or topics you would like to hear about, feel free to let us know. And don't forget to rate and subscribe the show wherever you get your podcasts. And again, thank you for listening, and be sure to tune in next time.